Morning. Happy Monday. Today's Monday, June 19th. Hope everyone had a nice weekend. Happy Father's Day to all the dads out there. I know I talk about my mom a lot on these videos because as the youngest of five, you spend a lot of time ripping around running errands with your mother, and you learn a lot about groceries and what you should, going to the bank and all those things. But thanks, Dad. Love you. Happy Father's Day. For those of you that don't know my dad, was my hockey coach as a kid, had a tremendous influence on me, not just my good looks, great sense of humor, love of puns, and love of Philly sports, but spent a lot of time together around the rink. So thanks, Dad. Love you. Happy Father's Day. Some boring stuff to talk about here, or at least not terribly exciting. We're going to talk about interest rates again. The Fed kept rates unchanged last week. This wasn't a surprise. We've been talking about it for weeks here. As May core CPI numbers came in at 5.3%, which confirmed that inflation is in a downward trend, which is positive news. That being said, if you guys listen to the press conference or watch the market, the Fed is projecting another 50 basis points worth of rate hikes between now and the end of the year. We're not going to lean too heavily on their projections because they changed their mind and they're just working off of what inflation numbers look like, which is part of their mandate. So historically, in the last 30 years, core inflation has averaged 2.4% when the Fed has kind of stepped away and stopped hiking rates or paused rate hikes. So one of two things is obviously going to need to happen. Either they're going to step back in and continue hiking rates later in the year, or inflation's going to continue to fall and they're not going to need to do so. So from listening to the conference and them speaking on the matter, it sounds like they're taking this time to kind of step away, evaluate what's going on in the economy, and they'll kind of get back at it here next month and towards the end of the year, and we'll see what comes of that. The market was up just north of 2%, 2.35% last week. S&P was up, so it wasn't no shocking news coming from coming out of that Fed meeting, which is good. One other interesting thing, and this started from a conversation with my mother that I wanted to look into, credit card debt. National credit card, household credit card debt is up to almost $1 trillion, 986 billion in credit card debt. It's a 17% jump from a year ago. Kind of just an interesting number. Like I don't want to speculate here, but it makes sense that the Fed's having such a difficult time squashing inflation if consumers are continuing to rack up credit card debt. What was really interesting from this, and with interest rates hiking, obviously credit balances are going to grow inherently larger with and we'll get into variable versus fixed rates, but as interest rates rise on credit card debt, most of which is going to be variable rate debt, those rates are rising, so it's kind of just going to compound the issue. But what was interesting is it's apparently, after doing some reading and some research, typically from Q4 to Q1, the credit balances fall or drop. So basically people go out and rack up credit card debt around Christmas time, buying gifts for loved ones, and come the beginning of the new year, pay down those debts. They're able to, eliminate them. We're good to go. That wasn't the case in 2023. So the first time since 2003, when they started tracking those metrics, that didn't happen. So that's a little concerning in terms of household consumers racking up credit card debt. And the average APR is 20.92%, which is the highest rate since '94 when the Fed started tracking this number. Just kind of a good opportunity to talk about good debt versus bad debt. Gordon Ramsay loves he all debt's bad debt in his mind, which he's got a lot of good things that we agree with, but this is one that we don't. He wants you to pay off your 2.5% car loan or mortgage as quickly as you can, which can make sense for some people, but the math just doesn't make sense for most. But with credit cards up at almost 21% APR, that is debt that that you should not be carrying unless you absolutely have to. So that we would consider to be bad debt. That is pay down immediately, pay down as quickly as you can, versus, if your mortgage is at 275 and money market's yielding 5.25% or 5, that rate isn't going to stay there forever, but you're losing money by paying down your debt early, where you could simply be putting it in a money market CD. You could actually, Johan loves talking about building a CD ladder to pay off his mortgage, which I don't think he's actually going to do, because we'd rather dump that money in the market anyway, as someone that's younger with time for the market to rebound. But that's all I got. Hope everyone had a great weekend. Hope everyone has a great week. We are working today. I know not everyone is, but enjoy the week, and questions, thoughts, concerns, don't hesitate to reach out. Thanks.